Good morning, everyone. Welcome to the webinar today. I've got Mark Penston with me. Hi, Mark.
Hi, Mena.
Just to talk the delegates through the software, you should have a box in front of you and you can ask questions. If you ask the questions, it shouldn't be broadcast to everyone generally. You will also see that there is a box that you can expand that's got handouts in it, and you've got a handout document that you can download and keep. So if you want to do that, then better to do it now than later because you might forget. And there is a chat box. If you type a chat message, you can type a chat message. I think you should be able to chat to everyone or just to us if you can use that facility, or just use the questions box. So Mark is with us today doing the second webinar. The first webinar, which you can find on either Mark's website or the Law CPD Solutions website, is available, and it's about drafting a letter for a single joint expert. Mark has got a team of people with him. Oh, bear with me. You should see there Mark's team. So Mark, talk us through the people that you've got working with you and what you do.
Yeah, well, we are a firm of chartered financial planners. The specialist work we do is pension sharing work, primarily the pension sharing reports and implementation of pension shares. There's an office of, in our office is 12 people, there's 5 advisors or planners. The 4 people that you see on the left are all the advisors who are involved in pension sharing work. So we've got quite a lot of depth and experience on pension sharing matters, and I'm a member of Resolution. I've gone through the IFA training to become, I think, what they call a financial neutral, so I can attend 4-way meetings. And Rob and Victoria are also going through the same training as we speak.
And that's been stalled by Resolution for quite a while, hasn't it?
Yeah, that's had lots of false starts. I suppose I was lucky enough to be one of the first to go through that training, which, you're right, has had all sorts of starting and stopping, but Rob and Victoria are patiently waiting. I think there's an exam coming up before Christmas, so hopefully that will get them through.
That's great. I've lost the agenda slide today, so we've been having a few technical problems this morning. So Mark, what have we got on the agenda for today?
Well, do you know, I wish I'd printed off this presentation so I could tell you. So I think it's going to be a surprise, but what we've intended to do in this presentation is pull out all the regularly asked questions from our lawyers and mediators. So nothing is overly complicated, but hopefully what we're going to cover are, the top 10 questions or areas where in our experience people say, well, I don't want to sound stupid, but can you talk me through this?
Yeah.
So that's what we've tried to cover. So it's part 1 and part 2.
And we'll be doing part 2 sometime in the new year, and the agenda for part 2 is at the end of the presentation, so
yeah,
we'll find out what's coming up. So the first slide is about pension scheme types, and this should be hopefully something of an overview for people.
Yeah. Just winding back one step, a lot of the material we're going to go through is what's available in our program that we call Workshops to You, and Workshops to You is a service, if you like, that we offer where we will go out to law firms and speak to family departments at their maybe at their departmental meetings or whenever. So just to let people know, if there are areas here that they want to hear again or to expand on, or other areas, then we can do that. So Mena, this first slide, talking just very generically about pension scheme types, and because I think this sometimes causes confusion because there's a lot of terminology our industry uses. The first scheme is Well, if you press the next button, Mena, what we've got is the two major types of scheme: defined benefit and defined contribution. So a defined benefit scheme is what other people will know as a final salary scheme. Final salary schemes, the pension you get will be dependent on your salary and your service. So final salary schemes are good generally because they provide guaranteed benefits, in contrast with a defined contribution, where the contribution is what's defined in the scheme. So this is how much you and the employer are going to pay, often termed money purchase schemes. But the benefits of these schemes will be based on the fund value at the retirement date, and the annuity rates applicable. We're going to come on to other ways of drawing pension benefits, but essentially those are the two scheme types. There are hybrids occasionally which we come across, which are a bit of both. So there are the odd scheme. I think Oracle ran a scheme for a while which had a bit of defined benefits in and a bit of defined contributions in. So,
But the best schemes are the final salary schemes, aren't they? Because they're the gold-plated pensions, aren't they? Particularly if we're dealing with clients who are, in the late mid-50s, late 50s, 60s. I mean, these schemes are going to be very valuable, aren't they?
generally speaking, that's absolutely right. Final salary schemes are a dying breed, and if you've got one, you should invariably want to keep it. So yeah, these are the good schemes. Not saying that money purchase schemes are bad, it's just that money purchase schemes have a different set of criteria, and that's the way of the world now.
Great, thank you.
So if just to give a couple of examples of defined benefit and defined contribution, this is a Smithline Beecham pension scheme statement, and I'm just showing you it just to say if you've got a statement like this, and you have a browse through it, what you've got here is you've got service details. So you're looking, what this shows you is the number of years service someone's put in. Remember, a final salary scheme is one of the functions of final salary scheme is how many years you worked, and also what your final salary is. So that's another. That's all right, thanks, Mena. So how many years you work, what your final salary is. There's also a breakdown of GMP, which we'll come on to as well, but that's the sort of thing you're looking for that will make you think, oh, this is a final salary scheme, because they're actually using the word final salary, yeah, and they're looking at years of service.
And actually, from my point of view as a family lawyer, essentially when people are given this information, particularly the date you've joined and when your pensionable service commenced, etc., sometimes where we're looking at sharing the pension over a period of marriage and we're looking at premarital contributions or sometimes even post-marital contributions, this is what we want to know. We want to know, when did they start paying into the pension, and then we would calculate when the marriage was, and then we do things, I guess, Mark, that you would think were horrible, and we don't ask actuaries to calculate it sometimes, and even if we do, we don't necessarily like the answers we're left with.
No. Looking at service, trying to break, let's say, this service down between pre and post marriage is a nightmare, because the one thing that scheme trustees rarely do is to provide us historic information about what pension had been accrued at historic dates. You just can't get it, so we then have to guesstimate it, and no one who does pension sharing reports likes having to be given the task of guesstimating how pension benefits have accrued.
And in fact, you and I were dealing with a pension sharing order a few years ago where we happened to have the date of separation value of a defined benefit scheme, and then we had the up-to-date one. So it was easier to do that, wasn't it, to calculate the post-separation accruals?
Yes, it was.
Yeah, so I mean, it is a difficult task. So moving on then to the next
Yeah, this is an example of a defined contribution scheme. So remember, this is where you've got a pot of money which is managed, and there'll be a few clues here. You know, Scottish Widows, it might be another insurance company or pension provider, might lead you to think this might be a money purchase or defined contribution pot. You've got lists of funds down the bottom of the screen. You've got the fact that it's a personal pension, you've got contributions listed, and then finally you'll probably see in your pack you'll have fund value, which will be number of units and the value of units. And this is where, with defined contribution schemes, the member will have their own pot. Their own defined pot, which can be defined by number of units and value, etc., as opposed to the final salary scheme where your money is in a big pot with everybody else's.
And so these are pretty common types of schemes. These defined contribution schemes are more common than final salary schemes.
They're becoming more common, yes, they're becoming more common, and I suppose the intention here is just to try and give a few pointers, so when you get the paperwork through, you can have a guess, you can have an educated guess about what you're being faced with.
Great.
Next on my elusive agenda is the pension changes. So we've been asked about what the pension changes that happened in April, the flexibility rules that came in. What do they mean? I'm going to start with really what's not changed, because actually very little has changed, but they've changed one thing which has made a big difference. And so just to revisit how pensions were and are, this is only relating to money purchase schemes, defined contribution pots, personal pension type schemes. It hasn't affected final salary schemes. So we're talking about personal pensions. You've always been able to get tax-free cash at 25%. Currently you can retire from age 55, so none of that's changed. You press a button, Mena. The options that you can have when you reach 55, you can take your tax-free cash, you can take the rest, the other 75%, as income, either through an annuity purchase, which is where you pass the whole pot of money to an annuity provider and they give you an income for the rest of your life, or what we knew as drawdown, a pension drawdown, which is where effectively you leave the money invested and you just draw money out as and when you need it. And the big difference here with the changes, we'll go on to the next slide, Mena, is the big change here is that whereas before April you could draw money, you could draw income out your pension up to a prescribed level, what Mr. Osborne did was to say that cap has now been removed. So the income you take is now uncapped. So hence, this is where the headlines were, and this is what you've all probably read in the headlines, is you can access all of your money from your pension. The big problem or the big issue which nobody seemed to was, I suppose it was the small print, was that if you take your fund, then it's going to be added to your income.
Yeah.
So quick example, pension fund of 400,000, you can take £100,000 tax-free.
So that's 25% lump sum that you've always been able to take.
Always the case.
Yeah.
If you then post-April took the other £300,000, that's all deemed to be added to your income in that one tax year.
Yeah.
So suddenly you could go from being a basic rate taxpayer up to a 45% taxpayer. You'll be really obviously heavily taxed on that. So you have to be aware of that. And I think the other thing to be aware of is that we have some clients going through divorce who want to access cash for various reasons, and they say, look, I'm going to take as much as I can from my pension, but I'm not worried because I'll be able to rebuild it later.
Yeah.
But I just have a desperate need for cash. The problem here is that if they access more money than just the 25% tax-free, then they limit their annual allowance, and the annual allowance is what they can pay into the pension.
Yeah.
Now, currently it's £40,000. So if we have a scenario where someone wants to get money out of the pension and then they say, well, we'll rebuild it later, beware, because actually you can only pay £10,000 a year to try and rebuild your pension, so that can obviously present some problems.
Pausing there for a minute, Mark, one of the things that I've noticed recently at court is that judges seem to be aware of the headline, which is you can, in money purchase schemes, have access to all of the money, but they don't seem to be aware of the tax issues. And in certain courts, they're not very keen on giving directions for pensions reports, and so it kind of ties our hands a little bit, because the judge is assuming that, you know, the person with a pension can draw it all down and maybe use the money to fund a lump sum, and not really allowing us to make the proper investigations. Have you come across that?
Yeah, we do. I guess we hear of it, because obviously what we don't hear about is instructions that we haven't got. But yes, unfortunately, we do hear of cases where the lawyer has tried to get has pushed for a pension sharing report. The judge has said no, because we can treat the pension fund like a bank account now.
Yeah.
Which is scary. Scary advice, and you know, they're not considering the nuances of pensions and the valuations, let alone the taxation angles.
I've also got, I mean, it's really difficult, isn't it? I've also got a question for you, Mark, which is this: is it right to say that it's always possible to access a pension at 55, or does it depend on the rules of the scheme?
Well,
I thought from
yes.
D-Day it was 55, but I'm not sure.
Well, if remember, we're talking about personal pensions here. Personal pension legislation says you can have it from 55 currently. Okay. If there are any schemes, if there are any personal pension schemes which have let's say 60 set as a retirement date, sometimes there are penalties or the loss of bonuses if you transfer out early, but the legislation says you can have it at 55, or you can certainly transfer it to another provider who would let you have access to it. So I don't think, I'd have to think about this, I don't think we've ever had a scheme, and I don't think there could be a scheme where they wouldn't let you have access to the money at 55.
And of course, government pensions, because they're unfunded, they set their own age of retirement, don't they?
Yeah, that's right.
Yeah. So generally, for the type of pension we're discussing here, which is a money purchase arrangement, you should be able to access it at 55, but there might be penalties for accessing earlier.
Yeah.
Okay, fantastic. Thanks very much.
So the next point on pensions freedom is, and this is a biggie for us as financial planners, is that pre-April, our advice used to generally be to clients, you need to do something with your pension fund by 75, because if you don't, and then you die after 75, there can be quite a high tax, 55%, on the fund. And so we would encourage people to, you know, buy an annuity or draw as much money as they could to empty their pension pot pre-75. Now, what the changes in April removed that tax and made pension schemes now an inheritable asset. So now, if I have a pension scheme that I don't need to touch or draw, I can pass it down to my wife or my children or my grandchildren or Mrs. Smith down the road. It is now an inheritable asset, and as most people will know, pensions are outside of the estate for inheritance tax purposes. So our financial planning advice has been pre-April, try and empty your pension pot before touching other investments. It's now turned 180 degrees to say, oh, actually, uh, leave your pension fund alone, empty your other investments first, and then go back and get your pension fund at a later date, because while it's in the pension environment, it's inheritance tax free. So that's general one-size-fits-all advice. It's not necessarily what we always do, but generally it has necessitated quite a rethink in some of our financial planning cases. And the final thing they did in April is this provision of pension guidance through MoneyWise, the Money Guidance website, also Citizens Advice Bureau can now provide guidance, and it's a stress on the word guidance, on this pension legislation and what people should do. They can't provide advice, and there is a big difference between advice and guidance.
And I'd never heard of that until you told me about it. I didn't realise that that was available. I mean, it's not a substitute for proper pension sharing advice in terms of divorce cases, but I suppose it's a starting place for people who don't know anything about pensions.
Well, it is. The government said they're putting aside £2 million, which I believe they have done for the provision of this guidance. There's also quite a big levy on every IFA firm to also fund that guidance, which is costing the government a lot more than £2 million. Well, my grumpy moment is we're footing the bill for the rest of that guidance, but there we go. So that's that. Now,
talk us through this example.
Yeah, quick example on a case which I guess benefited from the flexibility changes. So husband and wife getting divorced, he's 55, so he can take his benefits from a personal pension, funds worth £500,000. Now, in this scenario, he wanted £200,000 to buy his wife out of the family home, didn't have any money anywhere else, so he's thinking of drawing it from his pension. He can take 25% tax-free cash, which is £125,000, which leaves him £75,000 needed. Now remember, that's £75,000 of cash after tax. The way the revenue have told pension providers to tax such payments is that they have to use emergency tax code to pay out that £75,000. Now, without boring you with the tax calculations, in order to get £75,000 out after the application of emergency tax, this poor chap's had to take £133,500 out of his fund to end up with £75,000 of cash.
So not at all what judges think is happening. Judges think, oh, well, if you need the 75, take the 75 and there's no tax penalty.
That's right. That's right. So in this instance, he's paid £58,500 of tax. Now, yes, some of it will be reclaimable because although it's being taxed on an emergency tax basis, they can get it back. It's a bit of a faff to get back, but also this is another situation where he's had to pretty much empty a big part of his pension pot to do what he wants, and if he thinks he's going to rebuild it, rebuild his pension fund, he's now limited to £10,000 per annum to rebuild it.
So it's a double whammy for him, isn't it?
It is a double whammy. It's also worth, if you're looking at the top of the screen, I've used this as an example of a personal pension with £500,000 in it. We have had some cases, we won't go into at the moment, where we've had someone in a final salary pension scheme who is in the same scenario and wants money out. And in some cases, there is a piece of financial work where we can do that will help a client justify that transferring from a final salary scheme to his personal pension scheme in order to do whatever he needs to do can be justified. So that money in a personal pension scheme could have come from a final salary pension scheme. We do hold our breath a bit and we don't like these cases, but sometimes where there are no other options, it's an option worth considering.
And you mentioned this to me the other day because I didn't know that you could take the money from a final salary scheme and move it into a personal pension scheme. And in fact, I would have thought that would not be a great thing to do. And as you say, you don't do very many of these.
No, we don't. We've actually, over the last couple of weeks, we had a client who was not in a dissimilar situation. He was desperate to retain the family matrimonial home because he knew that if he stayed in that house, his daughters would stay living with him. So he had the emotional attraction of trying to do anything he could to retain a family matrimonial home, and one of the sources of, or pretty much the only source of cash, was from his pension, which was with BA, but he would then have to move that scheme from BA to a personal pension.
I've got a question somebody's asked, Mark. Will you automatically be reduced to £10,000 pension contributions if you withdraw more than the 25% tax-free sum, or is there another bracket? So is it just, if you withdrew 30%, would you just automatically be reduced to 10,000 pension contributions per annum? There's nothing in between.
No, as soon as you go over that 25% tax-free cash, you open that next door into the income pot. That triggers this reduction in the annual allowance. It's probably worth mentioning, seeing as questions been asked, that for very high earners, they can also have their annual allowance reduced as well. But we won't go there for the moment. But the answer to the question is yes, as soon as you go over that 25% tax-free cash and want more, you then trigger this annual allowance reduction.
Fab. Thanks very much for that, Mark. So we'll move on.
Yeah, and in this scenario, of course, this is where I think the financial planner who understands the case and what can be done could possibly consider, all right, rather than take money from your pension scheme, are there merits in remortgaging? Are there merits in phasing that withdrawal over more than 1 year, more than one tax year, so that you aren't bumping someone up into higher rates or additional rates of tax, whereby if you had spread it over a few years, you could make benefits from the tax angle, or could he take the tax-free cash and then do a pension share to the wife, and the wife, if we pretend she's a non-taxpayer, could then access the cash in a much more tax-efficient manner.
And that was something that I thought was an interesting option. And I think the thing with all these options is that you need to have a chartered financial planner who knows what they're doing involved from quite an early stage. So pre-FDR, let's say, and sometimes not just a single joint expert, where there are complicated factors, so that you can look at all these things and look at the best way of doing something to achieve the ends that the clients want to meet. Worthwhile taking that advice as early as possible, really.
Yep. Next is just a quick whiz through on state benefits and what's changing. Just a quick look at the current state benefits, and this is a really simple, Janet and John, if you don't mind, look at the current regime. Everybody gets a basic old age pension. Successive governments have tried to bolt on extra bits to the basic old age pension, graduated state pension, SERPs and S2P.
I don't think I've ever come across a graduated state pension in practice, to be honest, Mark.
It was only, I think I'm right in saying, it was a 9-year window when graduated state pension was available, and in some cases, if you get a BR19, so a state pension forecast, some of them, and the DWP seem to be producing statements in many different formats at the moment, but some of the BR19 outputs have broken down the state pension, and we have seen the basic old age pension and all the other constituent bits broken out, and we have seen, I think it's called graduated retirement pension actually, but so yes, there are occasionally, but it's not shareable. The BR20 form is the form where you can value the SERPs and S2P, so you can get the CE, because at the moment that is shareable. So the basic old age pension isn't shareable. The additional bits are, the S2P and SERPs are. I'm not covering it in a huge amount of detail now, but the basic old age pension, you can do what they call substitution at the moment, which is where let's say the wife can adopt the NI record of the husband if his NI record is greater.
And that's why we were never that bothered about the BR. I mean, I know it's important to you to get the BR19 when you're doing your reports, but I mean, the basic state pension would just match, wouldn't it? It would just match for, let's say, the wife to the husband's NI record.
Yeah, that's right. Well, that's right, but you know, we've seen significant differences in the state pension forecast from male to female, or between two parties, due to the additional bits as well. So
Okay.
Our view is always include state pension benefits, and that will increasingly be the case because as from next April, you won't be able to do any of this sharing. Okay. So that's where getting a BR19, in our opinion, should be part of the process of collating pension figures.
So what you've got on this slide is and of course, if you download the handouts in the handout section, the delegates will be able to get this information. Is at the moment we've got the BR19, which is the basic state pension forecast, and the BR20 that you've just been talking about, and you've got all the links there to those. And these last two I've not used myself, but if you can explain to us what those last two links are for.
Well, yeah, they're just, I mean, we use them all the time because, of course, the state retirement age is changing and it's all dependent on date of birth, and it's quite an easy calculator. You just put the member's date of birth and sex in and it tells you when their retirement date is. We'll come on to this a bit later, but our view is pension sharing reports should look at equalising pensions when all pensions are coming into payment, which of course is the last pension to come into payment will normally be the state pension. So we're looking to equalise retirement income at state retirement age.
And it's worth mentioning, you talk more about that in the first webinar that we did, which is on both your website and ours, about drafting a letter to a single joint expert.
Yeah. I haven't talked about it yet, but I'm just about to talk about the single tier state pension, and if you want a bit more detail, then that's available at that link below. So if we go on to the next slide, from next April, the single tier state pension is coming into force. You may have seen some state pension forecasts already showing the before and after benefits that a member would get.
Yeah.
They will get the higher of the two, but there's some interesting kind of anomalies and figures that are appearing, which as a result of some quite clever legislation drafting, I think, but essentially it was 30 years, it's now 35 years qualifying service, qualifying years you need for maximum benefits. The figure is just about to be released. I don't think it has yet, but it's about £151. That's the starting figure for the maximum state pension. As I said before, pension sharing of additional state pensions won't be possible. There are a few cases where it is still available, but you know what we're seeing is that £151. We're seeing statements where somebody has a has got 35 years NI record, so you'd think, well, they should get £151 because they've done 35 years. Well, what DWP are doing is they're saying, well, yes, it is £151, but if you've been contracted out of SERPs for any period in your working life, we make a deduction from that £151 for the period of time you were contracted out. We're going to discuss contracted out in a minute.
Yeah.
But what we're seeing is that some quite heavy reductions from the £151 because people have been contracted out.
And the ones that I've seen, as you say, I've got a few in that have got the two figures. So they'll say this is your number of years service, and under the current scheme you'll get this, and under the new scheme you'll get that. Are they paying the higher of the two figures?
Yes. Yes.
And when are they going to phase that out?
Well, it's just the single tier state pension comes in next April, and your state pension, if you are at that age, your state pension will tell you which you're going to get. You'll get the higher of the two. So no one's going to lose out at the moment.
Great. And as you were saying to me earlier, you in fact don't often see the pension sharing for the additional state pension that often, do you?
No, very rarely indeed. Normally, we would do pension sharing by equalisation from other schemes, not the state pension.
Right.
So we rarely see any sharing, and sharing of the state pension is going to go anyway.
Yeah.
From April.
Fantastic. So we were talking about contracting out. So you're going to explain the complicated nature of contracting out.
Yeah, this is very high level. There are ifs and buts and maybes, but here we go. So I've just replicated this image from before. So the state pension made up of the basic old age pension, S2P and SERPs. Where people have heard the term contracting out means that in two ways. First of all, if you weren't in a final salary scheme, you could contract out via a personal pension scheme, which is where your national insurance contributions stayed the same, but you just received a rebate of those national insurance contributions into a personal pension. That has now stopped since April 2012, and if you've ever seen a very old pension statement, you will see that those refund of national insurance contributions were called protected rights. They've now vanished, and legislation a few years ago said, well, protected rights are now just going to be normal benefits. So if you've contracted out via a personal pension, you will now see that it just looks like personal pension funds. Next button, Mena.
I've got one question before you move on to this. Can I just clarify that if you've got somebody who's contracting out via a personal pension scheme, what would you get back from the BR20? So let's say they have contracted out. If you send the BR20 off, would it come back and say this person's contracted out, or would there be a value up to the point that they contracted out?
The latter. What it would say is for the value of your the cash equivalent of your S2P or SERPs is X, which would include the fact that you've been contracted out for 10 of those 20 years.
Okay.
So it only value the benefits which you had retained while you were in S2P or SERPs.
So it's still worthwhile if someone says they contracted out, getting the BR20 form completed, because it could be that there's some element of additional state pension that hasn't been valued.
Well, yeah. Although with the caveat, as we mentioned before, is that actually, if we're looking generally to share other schemes rather than the state scheme, the BR20 is not as important to us as the BR19.
Okay, thank you.
So one way of contracting out was via a personal pension. Many other people who were in final salary schemes were naturally contracted out by their employer. And if you were contracted out via a final salary pension, then you and your employer would pay less national insurance, because the undertaking by the employer for contracting you out and paying less national insurance was that they would provide what is called a guaranteed minimum pension. So you will have seen in final salary defined benefit pension statements often a breakdown of income in retirement, and some of it called GMP.
Yeah.
It's a very dark and deep and complex subject, because GMP benefits have a range of different escalation rates depending on when they accrued, but us getting that level of detail is really important when we come to pension sharing, because it can make a significant different styles of GMP benefits can make a massive difference to how we share the pensions.
Okay.
So contracting out via final salary schemes is still available, but will stop in April 16 in line with the single tier state pension starting. And on the next slide, I've really just put into words, I guess, or into text what I've just said. Yeah, so that's pretty much so.
So is this single tier pension designed, if we go back a slide and have a look at what you've done there, is the single tier pension designed to simplify things in terms of people receiving pensions, and therefore simplify things in terms of pension sharing reports? Because there's definitely a view that I'm getting from the courts that pension sharing reports just aren't necessary anymore. I'm certainly finding it more difficult to get a direction to get a pension sharing report.
I think ultimately the single tier pension will simplify the state benefit system, but of course, because there's so much legacy in it, it's going to take many years for that complexity which we currently have to wash through the system. So that in a few decades time, what you will see is people just getting a single tier pension, a flat level single tier pension based on their NI records and nothing else. So SERPs and S2P and graduated state pension, that will have all gone.
But it's still necessary to get the pension sharing.
But I think it is. I really think it is. I think it's it's small value cases. Small value cases, yeah, you could get away with, because the cost of a pension sharing report, might be viewed, well, it's pretty heavy, and we've only got a pension assets of 100 grand or whatever, and that's maybe a ballpark figure. But once you're up into hundreds of thousands, the damage you can do by not getting a pension sharing report and carving it up the way you think best, the damage can be huge. Absolutely, particularly where there's the odd final salary scheme dotted around, even where there's only money purchase defined contribution schemes, where there's pots of money and people will look at them and think, oh, there's a pot of money, well, let's just carve it up. What a lot of people miss is that some of these pension schemes have quite valuable benefits, guaranteed annuity rates or guaranteed growth rates, that if you have the option, you wouldn't share one, you'd share the other one in favour of the one that has guaranteed benefits. So it can be a minefield.
So the general pension sharing principles you're going to talk us through.
Yeah, this goes back to the first thing is thinking about what are you trying to achieve. And the example I used of the husband wanting to buy someone out of the matrimonial home, for us it's useful if we can start, I think sometimes for the lawyer and the clients, it's useful if we are consulted very early on because we can start thinking about, what they're trying to achieve is, yes, a division of pension assets, but how and what age do they want to retire, and what other things do they want considered, and does one person want more cash for future property purchase, and all those different dynamics it will come into play. And we are doing an increasing amount of assistance where we are helped to understand the scheme, and then we can help draft a letter of instruction to be presented to the person who does the pension sharing report, which really makes some sense. I mean, we had one in this week where we've looked at the instruction, and with the greatest of respect, the lawyer concerned just seems to have put down everything he can think of that he might want us to look at. And it's turned into a 15 or more outputs that he's asked for. And if he took a step back and asked himself the question, now what am I trying to achieve, and what am I really asking, you can get to a much more focused letter of instruction, which A, is cheaper, B, gives more focus to the generation of the report, and what the clients get is something that they understand, and they're not picking over just to try and get the biggest or the largest or the smallest figure, depending which suits them.
And I think from my perspective as a solicitor, I've been guilty of doing that to you, I think, in the past, giving you, lots of different scenarios and ages and calculations that I want. And actually, when I've got the report back, I've kind of shot myself in the foot, because you've given me all the calculations, but I still don't know necessarily how to resolve the case. So it doesn't really help. And what you're saying is that if you were the single joint expert and the solicitors came to you as a sort of verbal exercise first to try and pick through what it is they wanted, and then drafted the single joint experts letter, it could end up being better. And I appreciate there are probably solicitors out there saying, well, that's easy to say, but actually getting two solicitors to agree something like that, knowing myself that recently it took a month to settle a single joint experts letter, and that was just for a valuation of a house. It can be quite a mean undertaking to get lawyers to sit down and do that.
Well, you're right, and you're absolutely right. And we had an instruction this week where we discussed it as a team actually, and thought, well, where do we go with this one? And we've actually gone back to both instructing solicitors to say, thanks for the instruction, but can we suggest that we look at it like this?
Yeah.
And we're making a suggestion which I think is hugely more practical, and is going to give them something which will give them the right outcomes, and probably is what they really wanted.
And I think that's quite helpful, actually, to have someone come back and say, did you really mean this instead of that? Because it does give a bit more direction generally.
Well, yeah, and it's meant to be helpful, and so yes, it's meant to be helpful rather than criticism. But we do start, I think our premise is when sharing pensions, the first principle is to look at equality of income. That's the first base. How do we share pensions to create equal incomes at retirement? I've talked before, I think, looking at creating equal incomes at state retirement age is the most appropriate way of looking at things. Yeah. Because prior to that you could be having a big variety of changing incomes. People taking schemes at 60 and then 65, and then it changes again at state retirement age. So we say, look, let's project it all forwards to state retirement age. How do we need to carve things up now so that at state retirement and onwards they'll have equal incomes? You've already mentioned, Mena, about benefits during marriage. Yeah. It's a bit of a pickle. The more information we can have and glean, the better. But yes, we do that. There's often offsetting considerations. So wife wants to retain a matrimonial home, so the husband says, well, I'll keep more of my pension. How does that look? And I've mentioned to Mena, I've been involved in a paper at the University of Cardiff
Yeah, this is
on
really
offsetting.
interesting.
If in a sad way, yes, I suppose it is. The paper's not out yet, so I can't say too much about it, other than I think one of the most interesting, fascinating things is as part of this process, we had a meeting in Bedford Row with barristers, other IFAs who specialise in this work, and actuaries, and we all sat around a table. There's about a dozen of us talking about the process we go through for pension sharing, and particularly with regard to offsetting. And there are many different opinions out there. It was a fascinating meeting, with the admission that I'm banging our drum a bit, we often get a pension sharing case to do, and we'll sit around as a team and discuss it.
Okay.
Which is really useful, because people will go, well, why don't we look at it like that, and why don't we do this, and what about that? And what was interesting in this session, that there's clearly some people who work entirely on their own, and when they got around a table and discussed different ways of offsetting or pension sharing, you could see that sometimes, on occasion, there were the people who worked on their own thinking, oh yeah, that's a good point.
Yeah.
I hadn't thought of that. And everything that people were saying was there wasn't anything incorrect, because they're all experts in their field, but there are more than one way to skin a cat.
Yeah.
And what we're looking for all the time is, how can we do this to provide the best outcome for both people? And sometimes you need to sit in a dark corner for some time or chat it through with someone else to come out with the right answer.
And what's really interesting about, from what I understand, and there's a LinkedIn conversation that I think has been started by somebody else involved in this project, is that 13 IFA pension experts have been invited. You were all given the same problem, and you all then wrote up your answer and submitted it for the paper. So when the paper is produced, we should have a variety of different views and responses from pension specialists on the same questions. Is that right?
Yep, it is right. There were 3 different case studies which we independently did and then got together and talked about. Was fascinating, and I think the whole drive of this is to might be slightly naive, but the utopia would be that a paper can be generated which gives some general guiding principles. For instance, we sat around and discussed the utility argument. Utility argument being that some people say money outside a pension is worth a lot more than money inside a pension, because you've got access to the cash and so on and so forth.
Yeah.
And there are various pros and cons for that, but the general feeling of these 12 or 13 experts was that actually the utility argument was a redundant, a completely redundant argument, and had no other benefit other than maybe some use depending which side you thought you wanted to argue, and was I think unanimously canned as a judge or a pensions expert doesn't really have any validity to use that argument.
So the results of that, I think, are being presented to a conference in November, I think, and then maybe we could talk about it in our second part to this webinar.
Yep.
Hopefully.
Yep.
So requesting too much information, that's what you were saying before about the 15 outputs, isn't it?
Yeah, and we had one, this is going back many years, I think I mentioned it before, I think we had one lawyer who gave us so many permutations it would resulted in a grid of 120 different pension sharing figures, which was completely balmy. But if you if you can discuss the case with the pension expert, you can get a lot of guidance as to what's the right way of doing this.
Yeah. Of course,
Fine,
with the other side, just to note that if you've got a single joint expert, then you would be trying to discuss it with the pension expert with the other side on a conference call.
absolutely.
Yeah.
Absolutely, or via email or whatever.
Yeah.
But joint, yes,
Yeah.
absolutely. Often asked, this comes up so many times. What's the
Yeah.
difference between an actuary and an IFA? And my take on it. And I have discussed this with a very well-known actuary who works in the pension sharing profession, who agrees what I'm delivering is not just an IFA's view. It's a very well respected actuary in this area. Pretty much, the actuary will do the number crunching. You give him the scenario, you give him the figures, or he gets the figures, and he'll do the number crunching as to how your pension should be shared to create equal incomes or whatever you've asked. It's a number crunching exercise. What they can't do is give financial advice. So often a lawyer might consult with an actuary before to say, what are you looking for, but certainly an actuary can't go beyond giving the report. He can't help with the implementation.
Yeah.
Can't give financial planning thoughts. Whereas an IFA, and I've put in brackets here pensions expert because I think this is the crux of the matter that we discussed, is an IFA can have that instruction discussion. Are there any financial planning thoughts? Is there anything we should be doing before we share pensions or whatever, all the way through to the pensions expert or the IFA can do the pension sharing report and then help with the implementation of that, and we can help. We often retain both individuals as clients, one to help them with the pension sharing implementation, and the other who's lost the pension, how can they rebuild their pension, what sort of income can they expect in retirement, that sort of thing.
And there are no conflict issues with doing that. If you were the single joint expert reporter, there's no conflict in you doing the implementation.
Well, we're very careful how we step through that, so you're absolutely right, but it is two distinct pieces of work. Our work as a single joint expert is an impartial piece of work to do the work as instructed. If a client comes back to us, it is a completely separate piece of work, a separate instruction, and if they come back to us during the process, then we would always get the acknowledgement and acceptance from the other side to say yes, they're happy that Mrs. Smith comes in for a chat, or Mr. Smith comes in for a chat, or they both come in for a chat as to what it all means.
Lovely, thank you. So we're coming towards the end of the webinar, so we're going to get through this.
This is a quickie. So this is just the result of, do I use an actuary or an IFA? It doesn't matter, but what does matter is that the IFA or actuary that you use is a pensions expert and understands the world of pension sharing on divorce. It is fair to say that there are actuaries and IFAs out there who don't understand the pension sharing world, and therefore that will impact on the nature of their output. So there are quite a lot of IFAs and actuaries who do pension sharing reports, and I think it's up to the individual instructing lawyer or mediator to ascertain whether they are experts in that field, can I just check it's not being outsourced to another actuary who's never done this before, which we've seen in the past. So it's not, we're not actuaries, we're IFAs, but we are pensions experts, and we've done pension sharing reports for years, it's that it's that you're looking for a pensions expert, not an IFA or an actuary specifically.
And in fact, on that exact point, a question's just come in, which is, if you send a letter of instruction to a financial planner, would they instruct the actuary to undertake the calculations to form the part of the report, or do you do the calculations yourself?
Normally, I would think in 90% of cases, we do all the calculations ourselves because we have the expertise, we have the technical knowledge to do that. There are some cases where we do use an actuary, so we outsource a very small amount of our work. We work with an actuary, we do some work for him and he does some work for us. Where there are, that's my point E there, where there are very complex schemes, and the very complex schemes particularly are the uniformed services.
Yeah.
So you know, the army, police, fire services, etc., where we feel more comfortable getting input from this particular actuary who I know knows these schemes inside out. So I think the answer to the question is normally we do them all ourselves. On occasion and where necessary, we will get actuarial input.
Yeah, that's important to know, I think.
Yep.
So this next slide then is going to our next webinar. We haven't set the date for the next webinar, but it will be in the new year. And if anyone has anything that they would like us to cover, then do send an email either to Mark or to myself. Our details are coming up in a moment. And just to remind you that if you've got questions as a result of the webinar today, do contact Mark. If you think it would be useful for him to come into your office, he does come in and do presentations. And in fact, that's how I know Mark, because I contacted him and he would come into my office at least once a year to give us an annual update. So I personally always found that really helpful. So we're going to revisit the letter of instruction, but of course the first webinar, which is on our website at Law CPD Solutions and Mark's website, goes into that in detail. And then we're going to look at all these other issues. Hopefully, Mark, number 4, we can look at offsetting in light of the report, which should have come out by then.
Yeah.
And Mark and I have been tossing over the difficult problem of judicial separation and pensions, so we're going to be looking at that as well. So thank you very much for your time today, Mark. If anybody needs to get in touch with Mark, his details are up there on the top right-hand side. Those are all of his qualifications and a little bit more information about Mark with his email address, and a little bit more about me with my contact details there if you need them. So thanks very much, Mark, and we'll speak again in the new year, if not sooner.
Pleasure. Thank you very much.
Thank you everyone for joining us today. Don't forget you can claim 1 hour CPD for undertaking the webinar today. Thank you very much.